In the last video, we valued the stock using a dividend discount model, but there are quite a few companies out there who either don't have a very long history of paying a dividend, don't pay a regular dividend, some don't pay any dividend at all, and some of them pay such a small dividend in comparison with what the stock is really trading at that you're wondering what was the market smoking when they came up with that price. We're going to talk a little bit about if a company pays no dividends, well, then what? And the then what really is the dividend growth model works well when a stock pays a substantial dividend. However, there are times when companies pay little or none of their ongoing cash flows as dividends. In those instances, we're going to have to use a free cash flow model. And at this point, I'm going to diverge slightly from what the book presents, because quite frankly I haven't seen 2 or 3 books that present this exactly the same way, and in fact some books are way off of other books because the way they estimate cash flow is a little different. And what's even stranger is in some instances we're talking about one type of cash flow, and in other times we're talking about another type of cash flow. So I'm going to actually call these specific types of cash flow. So for instance, if we were just looking at the price of the stock, then the current stock price is still the present value of expected future net free cash flows. And by net, I mean like the net income that goes to everybody. So this is free cash flow to the shareholder. I don't know how else to say that, so I'm going to call it NFCF. And if we do that, then we're looking at the price today being the discount and sum of all future cash flows to the shareholders, which I'm calling NFCF. Deal with it. And we're going to discount it at the same R sub S. In most instances, we're going to assume that N, the life of the investment, that's the small n as opposed to the big N. Yeah, I'm throwing in extra things just to confuse you. No. So the n, the small n, at the top of the summation, is the life of the investment, which we're going to assume is going to approach infinity. If we're going to take a look at something that goes out infinite times, and especially if it's cash flow, and unlike dividends, cash flows can go up, down, sideways, up, down, sideways, down, down, up, ups, down, up, down, 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 up, sideways, sideways, sideways. They go all over the place. In cases where no substantial dividend is granted, analysts typically make some simplifying assumptions. They're going to look at cash flows, they're going to model them out for a few years, and at some point they're going to say, at this point, I don't want to do them all the way out to infinity, and therefore I'm going to assume from here on out, from some point out in the future, that it's going to grow at a constant rate. As soon as they do that, as soon as it's been going all over the place, then it's a non-constant growth model. And usually these non-constant growth models actually have a combination of it's going to go wacko for the next few years, and then once it gets through this little growth spurt or whatever spurt it's in, then it's going to grow at a constant rate. That's the assumption that we're going to make just to make these models work. So for instance, you'll have to bear with me because this is a made-up stupid example, not a field trip example, okay? So if Buford's bulldozer is expected to earn the following net free cash flow amounts per share, and then grow indefinitely at 4.5%, assuming a discount rate of 14.5%, what would its stock value be? And there are the net free cash flows per share. Now, before I hit this one with everything I've got and show you this with PowerPoint and put you into a complete coma, I'd like to do this one in Excel and kind of think through it out loud with you, and then I'll show you with the PowerPoint all over again. So it's like we'll do this twice, sort of. Okay? So bear with me. Okay, we're in Excel and we have the same numbers that we had. These are my net free cash flows, 1 through 5. At that point, I'm expecting this to grow at 4.5 to infinity. And by the way, what we could do in Excel, this will come really close to doing what we wanted it to do anyway, is if we get this to be a really big number, because that's really what infinity does, so bear with me as we do this. I'm just going to go down here to maybe time period 500 years in the future when I'm dead and no one actually cares anymore what I ever bought as a stock. So there we go. We have all the way through 500. And at this point I'm going to say I'm going to take this number here and multiply it by 1 plus 4.5. It's going to grow at that rate forever. Okay, so we are now at 334. Except I really wanted that to always hit G, and now we're ready to go, and I just do all the rest of them. So that's consistent with my assumptions. Okay, so just gonna move these over here somewhere so that I don't take up everything. Okay, and at this point what I'd like to do is a couple of things. So if these are the net free cash flows, I am going to look at what the price should be, just going out to 500. Now notice 500 is not infinity, but it's close enough for me because I'm not going to live that long. So I'm going to say P0. And I'm just going to use a subscript and say my P sub 0 would be equal to the net present value at this rate of all of these by the way, notice how big those get. 9.28 times 10 to the 9th. That's huge. Enter. So this is going to be huge, right? It's going to be $24.44. Well, that's just freaky. Did it notice how big those are at time 500? Just for fun. That means I'm assuming that in 500 years my free cash flow per share is going to be, let's see, those are thousands, million, 9,283,542, whoops, 9,283,542,920.48. Wow. Talk about inflation. Probably. That's a good chunk of it. Anyway, 2444. Wow. With that kind of money out there, 500 years. Of course, we're discounting it at 14.5% per year, so that's half of our battle. Here's what we're going to do so that we don't have to do this in Excel all the time, however. I'm just going to look at the 5 that I've been given, and in fact I'm going to highlight all these other ones which can go on and on and on, as we've seen, forever. I'm going to just turn them green. Well, no, because we're with Tarleton, we better do them purple. So we turned all those purple. I'm just going to work with this stuff right here to show you that these are the only ones I need. The first thing I need to do is take care of all of this stuff down here. Okay, the 6 to infinity. Not just to 500, but to infinity and beyond. I would like to know what all of that's worth from there on out. And to do that, I'm going to do that Gordon growth model, but at time 5. So I would find out what all of those are worth in time 5 if I do the Gordon growth model in time 5. So I'm just going to do the following. I'm going to say equal. Let's see if I remember my, of course I do because I do this enough. This is you trying to remember, however. So I'm going to get my 3.2 times 1 plus 4.5 divided by R sub S minus G. The reason I'm in time 5 is that's when I have my dividend. This is not a D sub 0, it's a D sub 5. And therefore I'm finding the value in time 5. So I hit enter, I get 33.44. Well, that's not even close to 24.44. But wait. Because at this point I'm going to then say, so what is all of the cash flow? So this is the Gordon growth model cash flow stuff, and then I'm going to say what is the total cash flow, and let me draw a little line there. Whoops, let me also, wow, let me center those just to be, wow, those don't center. Okay, never mind. So on this one I'm going to be looking at equals this one plus that one. The only time I do a Gordon growth model is right at the end of the stuff that I'm doing. I'm just doing these 5. I'm seeing if I can get the same number by just going through these 5. 3664. Now, just using those, I'm going to say equal net, whoops, equal net present value. Same rate, comma, 1, 2, 3, 4, 5. This one includes the 320 for that year plus the present value in time $5 of every cash flow from there on to infinity and beyond. Okay, so I'm going to use those, close my parenthesis and hit enter, and I got the same number. And you may say, how did you do that when that last one was so huge? And I've obviously not taken into account all of the infinity ones, but the ones from there on out don't amount to anything anyway. I knew that when I did it, so wow, I get the same answer. And with the first one I needed to calculate out 500 times. With the second one I didn't have to do anything other than right there. So again, and this is why I needed to do this not just once but twice. What the heck? So let's go over here and see what the heck. So here's the way we're going to be doing this essentially. To find these non-constant growth, first we consider the price of the stock at time 5. The price of the stock at time 5 will give me the value in time $5 of all of the cash flows after that. Why did I choose time 5? Because after time 5 we're assuming a constant growth. So time 5 is the time to start doing that, because then I can use the Gordon growth model. So I use the Gordon growth model. But instead of saying P of 0, we're going to say P of 5. Instead of saying D sub 0, we're going to say D hat sub 5. And we're going to plug in the dividend, expected dividend at time 5, and then everything else is pretty much the same as what we did before, and we get $33.44. Next, We're going to sum all the period cash flows in those 5 time periods, the 125 plus the stock value. Well, we're not doing that until time 5. Then the 275 times the stock plus the stock value, but we're not doing that until time 5, and so on until we get to time 5 when it's $3.20 plus the stock value, which is really the value of all of the other cash flows in time $5. And so we've converted them all essentially. So we get the 320 plus the 33.44, and in time $5 we get a total of $36.64. Now all we have to do, because now we've taken into account every single cash flow from time 1 through infinity, it's just that the cash flows from 5 to infinity are all in time $5, so we don't have to go beyond that. And so we're going to do a net present value of all of them, or we could do them all separately. So to see what we're doing if we do them all separately, we have 0 through 5, and we put all of our numbers in there: $1.25, $2.75, $1.50, $2.80, $36.64, and time 5, which includes all of the other cash flows, or at least the cash flows in time $5. And then as we discount them at 14.50% to time 0, $1.25 becomes $1.09, $2.75 becomes $2.10, $1.50 becomes $1, $2.80 becomes $1.63, and $36.64 becomes $18.62. And then as we sum them all up, we get the present value of $24.44, which is exactly what we got before in 2 other ways. I'm trying to get this so that it will make sense one way or another. If you're wondering why we're doing this over and over and over again, it's because I need to get you to understand that the non-constant growth allows us to look at things that don't grow constantly, but eventually we're going to have to assume a constant growth so that we can get out to infinity. It's either that or you're going to have to do a whole bunch of them. I'm hoping you notice though that if you did out to 500, hey, you could probably go away and say, hey, I'm assuming that we're there, but I don't want to do 500 of them either. Like I said, I'm not going to be alive that long. So that's the non-constant growth example. Now, in addition to that approach, and I'm trying to give you 2 or 3 or 4 different approaches because honestly, over the next few homework assignments, we're going to be doing all of these different approaches. There was first off the dividend discount model. Second, a valuing of the firm using cash flows to shareholders. And now third, we're going to be valuing the total firm, not just the equity per share. And then there's a few reasons why we're going to do this. This is an alternative way of saying we're trying to maximize the value of the firm. It's also an alternative way of valuing the stock itself per share. The way you value a stock per share using this approach, and by the way, there are many professional stock analysts who use this approach, is you value the entire firm. You come up with a way of valuing all of the firm. And what we are going to use in this case is what I call operating free cash flow. This is cash flow that accrues to all investors, both debt and equity investors. And because of that, this is the one that is quite often used in corporate finance textbooks, whereas the other one might be used in a stock valuation model. This one is typically used in corporate finance textbooks. Once we get a value for the entire firm, we tend to subtract out the book value of all of the liabilities. If we do that, we'll get the total economic value of the firm to the equity shareholders. Once we get the total market value of the equity to everyone, we can divide by the number of shares outstanding and end up with the price of the stock all over again. So if we're going to do that, we would probably do something, and by the way, quite often we end up doing this as we just did with the non-constant growth model. because when we talk cash flows can go up and down and sideways and all over the place. I'm going to simplify some things and do a kind of real example because I'm tired of the goofy examples. And unfortunately, I'm not going to do a non-constant growth model yet because we haven't gotten to where we can actually derive these. Although we will over the next few chapters with your company. Try to figure out what the value of the firm is and what's driving that value of the firm so that we can improve it. So here's what we would be looking at in this instance. We would be looking at something that looks very familiar, only instead of P sub 0 we're doing V sub 0. This does not mean that I don't know how to pronounce my letters. V sub 0 is the value of the firm at time 0. And in that instance we're going to take the expected operating free cash flow. We're going to divide by 1 plus the weighted average cost of capital. I'm hoping at this point you can see that there's several reasons why we can't apply this one to our firms quite yet. Number one, we haven't looked into the future. We've looked in the past. We haven't looked in the future at what the operating free cash flows of the firm are. Number one. Number two, we haven't estimated the weighted average cost of capital. And so we've got a few other inputs that we really have to work on before we can apply this to our firm. But let me go through the process here really quickly. Again, we're going to assume that that n, in this case the n that we're going to is the one on the top of the summation sign, is the life of the investment and that it approaches infinity. And again, my example is Rocky Brands. I'm going to use an oversimplified model for Rocky Brands primarily because we don't have much of a background to do much more than just a very simplified model. Oversimplified models, though, tend not to hit very close to what you're observing in the market, just as a warning. Okay, so I'll use an oversimplified model of Rocky Brands, but only looking at the Gordon growth model, Gordon constant growth model. The inputs that I'll need, therefore, are the operating free cash flow, which I'm going to use the following. We're going to be looking at earnings before interest and taxes, adding back depreciation, amortization, any impairment. Impairment's usually not listed in textbooks, and it really should be. It's like any of the intangibles that we impair, or any assets, long-lived assets that we need to bring down to market. We do that through impairment. And it's sort of like recognizing depreciation and amortization all at once. So I always add back anything that is listed for impairment. Now usually textbooks will then say multiply that by 1 minus the tax rate. But I'm going to be looking at the historical stuff just to give us something to work off of. So I'm just going to add back or subtract out the actual tax. So what we're going to be doing is we're going to be looking at the earnings, adding back the things that are primarily non-cash items. Then we're subtracting out the tax. This is the after-tax estimate of cash flow. We'll be looking at growth, and again I'm going to be looking at how fast it's been growing over the last little while. I could easily tell you right now what I'm going to use as an estimate, but I think it's best if we actually look at it together, and I'll say, oh, okay, this is the growth looks like it's whatever percent. Then we're going to be using weighted average cost of capital. We're going to use a whole chapter to estimate your weighted average cost of capital. I'm just going to be looking at 5.94% for my company because I think it's pretty close to what their weighted average cost of capital is in that company. Then we're going to throw it into the Gordon growth model. This is essentially the same Gordon growth model, only we have to make a few adjustments. Instead of the cash flow or the free cash flow or the dividend, we're now looking at the operating free cash flows. We're going to allow them to grow at a specific rate. That's the 1 plus G. Then instead of looking at The discount rate being R sub S, we're looking at a discount rate of weighted average cost of capital minus G. This is the exact same thing. We could have derived it the exact same way. We would have gotten the same thing that I'm showing you here. This will give us the total value of the firm in dollars. Now, it's probably going to be a huge number because Rocky Brands, honestly, has hundreds of millions of dollars in assets. So we're hoping to get hundreds of millions of dollars worth of value for the firm. Otherwise, we may have a problem getting our equity to be worth anything. Let me see if we can estimate the OFCF, and then we'll talk about the G, and we'll come up with this V sub 0. Okay, this is the Rocky Brands balance sheet, income statement, cash flow statement, and ratios. Complete with a graph of what's happened with their net margin over time. I don't know why I did that, but what the heck. So, let's take a look at our earnings before interest and taxes, which is on the income statement. So I'm going to scroll down here somewhere and say, these say cash flow estimates, but we're going to do a different set of cash flow estimates. In fact, I don't even know how I did those. This had to have been for a different class, I'm hoping. So I'm actually going to hide those. Yeah, you can hide them. You'll notice that the rows are still there. It goes 49 to 54. I don't even know when I did those. So here we go. We're going to say equal, oops, let me do operating free cash flows. I'm going to take our operating income, so I'm going to scroll up here and find income from operations. And then it says I want to add back plus depreciation and amortization, which, by the way, you may have noticed I went to the cash flow statement for that because that's where those usually live. And I'm going to say plus, see if there's anything else down here. There's nothing that says amortization, but I do have one that says intangible impairment. Now this one's 0, but if I hit this for this one anyway, when I get over here to 2008, I'll actually pick up a number. Okay, so there we go. And then it says I should subtract out the actual tax. So I'm going to go back to the income statement and grab that income tax expense and hit enter. And then I'm going to pull that one across. We only go through 2008. Well, there's one that I really either made a grundle on. Oh, well, I guess not so much. Or the column was just too narrow to begin with. So there are my free cash flows. 21 million, 14, 19, 14, 15, 13. If there's any trend that looks like it might be not a positive one, because remember we're going 2008 to 2013. So based on that, the kindest G I could give them is probably a 0%. 0.00%. And so again, let me repeat, my weighted average cost of capital I'm going to assume is 5.94%, and therefore the value of the firm, actually let me do this really quickly, yeah, is going to be equal to, and I'm just going to take the most recent one, multiply it by 1 plus G. I know I didn't have to do anything because that's multiplying it by 1. but I have to follow the exact formula or people get lost. Okay, so I'm going to do that divided by the weighted average cost of capital minus, gee, I know that's just the same weighted average cost of capital, I know, which gives me a big number, thank heavens. Actually, just so that I can see what's going on, let me do it that way. So $232 million. Now what's interesting about that number, by the way, is now let's compare that to the total assets. The book value of the assets are $199 million, and I'm estimating $232 million. Now, by the way, note that if we get a negative, and by the way, negatives are less than the R sub S, or in this case the WACC. So if I got a negative 1%, that would come really close to the book value of that asset, or the assets, and I would point out also that it's more realistic because these are actually going downhill rather than uphill. But I'm going to replace that back with my 0. To get the stock price, we're going to use the value of the firm to estimate the stock price. We merely have to subtract the liabilities from the value of the stock, the total firm, leading to the market value of the equity. In other words, equity is equal to V sub 0 minus the total liabilities. Then we'll take the total equity estimate and divide by the number of shares to arrive at the stock price estimate. So let's look at the equity. By the way, I happen to know that this firm actually trades below its book value of equity, so I think we're going to be high with that 0%. But anyway, equity is equal to value of the firm minus the book value of the liabilities. So I'm going to just look at the book value of all liabilities outstanding. We're going to get some huge number, and again I'm just going to make that wide right there so I can take a look at it. Then I'm going to say, so how much is that per share? Now, price per share is going to be equal to my equity divided by the number of shares outstanding at the end of the year, and I get 2192. Now this is high estimate for what they are currently trading at. Let me go show you what they're currently trading at. So 1376 is what they're currently trading at, but I've already shown you that it looks like their cash flows are not growing, they're actually declining. So if we get this to be 1%, first off, oops, not 1% growth, I need to have minus 1%, then this number, the market value of the firm, is closer to the book value of the assets. But if we were looking at how fast is that growing on average, how much is that going down essentially, it's probably not 1%. It may be 2%. If we're talking 2%, that one's way low, and again we're overestimating the value of the assets with our current book value, and yet the price is really close at negative 2% growth. And just so you can see that that's not that bad, let's actually take a look at how fast that has been growing. So we'll say equals this number minus this number, whoops, this number minus this number divided by that number. And that's a negative 33.8%, and this is the OFCF growth. And if we highlight all of these and look down here at the bottom, we can find an average of negative 6%. So negative 2% is actually being kind, and it puts us really close to the actual stock price. And that's the end of this second video. In the last video is going to be very, very short in comparison to these first two. And we're going to spend some time looking at, so what about these market multiples?